Welcome to the Strategy of the Week presentation for July 5th, 2013. My name is Todd Shaffer, Manager of Research for VectorVest, and I'll be providing your strategy presentation this evening. Over the last 2 weeks, we've explored new functionality added to the program with our last update, our new Welcome tab, getting started with WatchLists, and using trailing combo stops in the Backtester and Portfolio Manager tools. This week, we return to our WatchList presentation from June 21st and the watchlist we created in that presentation. In this demonstration, we showed how easy and important it is to create a watch list, and how we can use the VectorVest VST system of analysis to analyze the stocks in that watch list. This week, we'll go a step further to explore how we can fix a portfolio that's become broken, stagnant, or is just plain underperforming. The process really begins with your understanding of your own goals and your sensitivity to risk, which we call your investor temperament. Dr. DiLiddo wrote about this extensively in his book Stock Strategies and Common Sense, devoting a whole chapter to the subject, and I highly recommend that you reference Chapter 11 in that book. In that chapter, Dr. DiLiddo identifies 4 investor types: conservative, prudent, aggressive, and speculative. He arranges them in a matrix to visualize their relationship to reward and risk, and to each other. So let's set that up. The investment matrix then has an X and a Y axis. On the X-axis, we have, going across the bottom of the matrix, risk, and on the Y-axis, reward. And so we have this relationship between risk and reward, and as we see rising reward, we also usually see rising risk. And that balance point, or that tipping point between how much risk do I have to take on to get the reward that I want, is unique to each of us. So now let's overlay our investor temperaments onto the matrix. And here they are: conservative, prudent, aggressive, and speculative. And so we see, if we think of the continuum, that the conservative investor is lowest on the reward and lowest on the risk scales, where the aggressive trader is highest on the reward and highest on the risk scale. And notice that we've associated some relative value and relative safety scores with each of these temperaments. And for a quick review, remember that RV stands for relative value. RV is a proprietary VectorVest indicator, and it indicates the price appreciation potential relative to a AAA corporate bond for that company. RV scores above 1 are favorable, meaning it should outperform that bond in a 1 to 3 year time frame. The higher that score, the more upside potential. The second indicator, RS, relative safety. Relative safety indicates the consistency and predictability of the financial performance of the stock. These guys with high RS scores are the steady eddies. Low volatility is another way to think of these. Scores above 1, again, are favorable. The higher the score above 1, the safer the stock. And so we have that combination now of reward and risk. We begin with the prudent investor. The prudent investor is one who wants to outperform the market but doesn't want to take on a lot of risk to do that. And so expressed in RV and RS values, that would translate into an RV score above 1 and RS score above 1. If we move next to the aggressive investor trader, the aggressive investor is looking to greatly outperform the market and is willing to take on some risk to do that. So their combination of RV RS is RV values above 1. RS values can be below 1, indicating that they're taking on a little more risk. Stepping back to the low reward, low risk conservative investor, the conservative investor is typically first and primarily concerned with preserving capital, and so high safety is their primary concern. They don't have to outperform the market. They typically need strong, solid, consistent performers that pay a reliable dividend. And while they certainly don't want to lose money, they don't mind lower performance to give up or trade for some of that safety. They can have RV scores below 1, but RS scores well above 1. And finally, the speculative investor. The speculative investor is one who typically isn't worried about the fundamentals of the company at all. Speculators are typically trading on news or events. Will the patent get approved? Will the medical device pass its tests? And so they're not typically concerned with the fundamental strength of the company at all, just whether or not whatever it is they're making or inventing will prove to be worthy. And so on an RV-RS score, they can have both RV and RS be below 1, and that doesn't concern them at all. They typically will have many losing trades, but they'll have that one big one, that one big fish they land that makes up for the difference. Now, the important part for us in the context of fixing our portfolios here is, where do you fit on this matrix? You may be a combo type, but which is your dominant style? By extension, then, does your watch list reflect this style? If we look at your watch list average, will your combination match with your investment style? Often, portfolio problems are due to a mismatch of temperament and stock type. For instance, hoping the Canadian National Railway will go up 20% in the next few weeks. Or conversely, that a pharmaceutical or a mining company will have a nice steady price increase over the next 3 years. And so if you remember from Kathy's talk, let's go back to the program. On the Viewers tab, we'll come down to Watch Lists, and remember we were in the My Watch List folder, How to Manage Your Stocks. And so if we look at our RV and RS values, they're both well above 1. This is a very prudent watch list of stocks. And as I look through the values of the stocks within the folder, I see that Sears Canada on an RVRS basis is actually a relative conservative play, as is IGM. Of course, if Sears continues to lose some of their safety, they could become a speculative play. But as Kathy indicated in her tutorial, what we want to do is, as we replace these stocks, or replace any stock, we want to replace them with new prudent stocks that are going to raise our average. And so here's one of our key concepts. We're going to repair this portfolio over time. This does not have to be done in one fell swoop, and I wouldn't go scuttling the whole ship and starting over. Remember, we're going to take the watch list, we're going to sort it by RT descending, and we'll start working from the bottom up. And we're going to start the process by applying some rules, 4 indicators actually, of when you need to be worried or it's time to be careful, to watch out, and 4 hard and fast reasons why you have to sell the stock. So let's start with the 4 early indicators of when to sell. There are 4 early indicators, or warning signals if you will, of when you might need to sell the stock. We'll list them here and then we'll go look at some graphs. First, when we bought the stock, hopefully we saw a smooth, steady rising price and earnings using the VectorVest simple methodology. Well, how is it now? Has price action changed and now become more volatile? Is the price trend starting to break down or slow down? That moving average can be helpful in identifying a breakdown in that trend. Secondly, if the price falls below that 40-day simple moving average, a second warning signal. Third, if we see that RT is diverging from price action or is actually crossed from above to below 1. And finally, have you gotten a new sell recommendation on the stock since you bought it? So let's go back to our watch list and look for some of these early warning signals. Back in the watch list viewer, let's minimize the viewer's window so that I can get to the Graph All button. Here we've pulled all the stocks into the graphing tool, and we've laid out what's called VectorVest Simple, which is the price of the stock, its value, and earnings. And this is the layout that we teach to use for our initial assessment of the stock, because we want to see, over a 1-year time frame, steadily rising price patterns and steadily rising earnings patterns, because these steadily rising earnings are what's going to drive future valuation and future price appreciation. And so although AVO is overvalued currently, prices above value, we've got that nice price pattern and supported by earnings per share. Let's just scroll through these, because this is the assessment that we should have done initially when we took these positions. Well, I can also look at them now and say, well, gee whiz, if price action has broken down, what's going on with earnings? Of course, looking at this stock now, this is Sears Canada, I don't know that it ever had that trend that I would have gotten into this to begin with. All right, so this is the VectorVest simple methodology. Do I have nice smooth price action supported by rising earnings? And when earnings trend breaks down in particular, that's another reason to be cautious. So let's scroll back up to our first graph. And we're going to make a slight change. I'm going to take off value, and I'm going to put on a 40-day moving average of price. And so the first thing we look for is what's happened to the volatility of price. Is price action getting more volatile or less volatile, or staying about the same? And secondly, what does the moving average tell me about its trend? In other words, this moving average is still sloping upward, telling me that the 40-day trend of this stock is still upward. And I notice how this 40-day moving average tends to be a pretty good trend line for this stock. And so if price were to break down below that trend line, that would be a warning flag to me. Of course, price did pull back a little bit here with the latest market correction. That doesn't surprise me a lot. But let's scroll through some of the other stocks within this watch list. Just looking at what does the moving average tell me about trend, what's going on with volatility, is that uptrend, that series of higher highs and higher lows continuing? Here's a case where the earnings pattern did pull back here in February through April, but the market just kept on chugging along, and so we don't necessarily want to pull the trigger just because earnings performance is falling off, but it would have been an early warning flag to me to keep an eye on this guy and see if it lost favor in the market. And so this guy, we see increasing volatility here. It pulled back to the 40-day moving average, which is still sloping upward. This would have been a good time to keep an eye on this stock. Nice proxy trend line with the 40-day on this stock. And here's our bad boy, Sears Canada. Obviously lots of volatility within the movement of the stock price here. Erratic price section, no nice extended trend. Earnings performance has been erratic. So for those reasons, this guy's probably already on my watch list. But right now, price is above that 40-day moving average, which is trending upward. It's moving a little bit sideways here right now. I'm assuming at this point it hasn't hit my sell trigger, so I'd continue to hold this, but definitely keeping a watchful eye on Sears Canada. Stella Jones has resumed its nice upward trend in both earnings and price. Here's an interesting character in Canadian National Railway. Price has gotten now fairly choppy here, moving mostly sideways. We've seen a couple reversals and crossovers of the 40-day moving average. This guy probably raised some yellow flags back at this reversal and on this reversal as well. And so if we quickly scroll through the rest of these shares, immediately things start to pop out when you see a lot of volatility like in Toronto Dominion in a relationship with that 40-day moving average. So our first two indicators were price action, both volatility and trend, and the price crossing that 40-day simple moving average. Scrolling back to the top of our list, let's take off our earnings indicator and talk about our third method, or our third indicator to watch for early warnings, and that was relative timing. Now looking at AVO, the best time to buy stocks is when RT is rising, hitting a series of higher highs and higher lows. When RT is falling, then generally we're losing strength in trend, and generally that's a time to be careful if you hold a position, or to be careful if you're considering taking on the position. And of course, crossovers from above one to below one indicate a crossover from uptrend to downtrend and are certainly an early warning flag. And so we saw with AVO that it was trending upward nicely. As it flattened and consolidated here for about 2.5 months, we started losing strength in that momentum, or losing strength in that trend. Price started moving sideways here, and look how the RT oscillator just bounced around that baseline of 1 because we were basically moving sideways. Price action takes off again, RT crosses above 1 and indicates that strong uptrend. And so we see it again with MG. Here again we see a great illustration of where that RT starts dropping off, price action is flattening out. But look currently how price action is still hitting a higher high here, but RT is falling off. And that's a great early warning flag that the momentum of this uptrend is waning for AutoCanada. Is it time to pull the trigger and sell AutoCanada? Well, not yet. We're going to talk about the triggers next. But this is definitely on my radar as being a potential sell. And of course, if it's helpful to you, you can create moving averages for RT to help you discern the trend of that RT indicator, just as we did for the RT Kicker Combo timing system. And our fourth early warning signal was a stock that just got a sell recommendation. So if we drag down to the bottom here to BlackBerry, on our gap down here, we'll put on our recommendation. And we see here that BlackBerry got its sell recommendation here on the 28th of June. And with the sell recommendation, you've probably heard us say you can use it as a gospel or a guide. We're assuming at this point that it's a guide and that it's telling you, hey, something's wrong, you need to look at this stock. At this point, you would try to make the determination of, is there any reason for me to continue holding this stock to think that it's going to rebound? And what a great example. It had been in a nice uptrend, but it has broken through that 40-day moving average. The 40-day moving average now is actually sloping downward. Our price action is consolidating where it's actually hitting lower highs and higher lows, and ICRT is hitting lower highs. See how all of these early indicators came together to help identify a stock that was losing its luster before it came time to actually pull the trigger. But let's talk about the triggers. How do you know when it is time to absolutely sell? Well, let's go back to the PowerPoint. Broadly, there are 4 reasons for you to sell a stock, or 4 triggers, if you will. The first is they're all related to your trading plan rules. In other words, all of these rules were determined before you ever took on the position. And how did you determine those rules? By doing some back testing with the VectorVest tools, or through extensive visual back testing by looking at a lot of stock charts. But those trading plan rules, which include the 3 pillars of when to buy, what to buy, and when to sell, on the when to sell leg, we're saying the first rule is the stock hits your predetermined stop criteria. If you predetermined that a 10% trailing stop was the best stop for the stocks that you trade, and your stock hits that stop, you need to sell the stock. It's the breaking of our discipline or the rationalizing away of our rules that gets us into trouble. So if your stock hits its stop, sell it. Your trading plan may allow for the adjustment of stops based on certain parameters. For instance, if price falls below the 40-day moving average, I'll tighten up from a 10% trailing stop to a 5% trailing stop. But those accommodations are all predetermined before you ever took on the position. Secondly, if you get a new sell recommendation with falling price trend. Remember, we talked about the sell recommendation can be used as gospel or guide. We used it as a warning flag to go back and look at price action in the previous example. In this trading plan, we're using it as gospel, where we're saying, you know what, if it gets to a sell recommendation, I'm out of the position. With the notable exceptions, of course, of bottom fishing. Third trading plan trigger that would exit a position for you is if your market timing signals an exit. An example being where you've decided to go back into cash should you get a confirmed down call. And the fourth reason to sell any position would be that you've gotten a warning in the VectorVest views that Dr. DiLiddo sees reason for us to move to the sidelines and get back to cash. And so when applying these rules and these methodologies, if I go back to my watch list, I can apply those rules and I can come down to BlackBerry with confidence now and say, BlackBerry, I love you, but the market doesn't, and so therefore, neither do I for right now. Let's clear you out of the portfolio. And when the market timing is right, let's replace it with a top VST stock that has strong fundamentals, that's in an uptrend, that has a nice price and earnings graph performance, and we'll rebuild the portfolio. That'll conclude our strategy presentation for today. Hopefully we've given you some ideas that you might be able to apply to your portfolio to help fix or repair either a ill-performing or an underperforming portfolio. I'd like to thank you for watching, and of course, if we can be of any help, call us at our toll-free number or send us an email at productsupport@vectorvest.com. And of course, if you'd like to see Kathy's or any of our previous Strategy of the Week tutorials, just go to the VectorVest University at vectorvest.com/VV University. And of course, until we see you again next week, happy trading.